Hey guys, it's Sasha. The Federal Reserve has reduced interest rates by 50 basis points this week because the Fed is now panicking about being way too late with reducing rates. But at the same time, according to the Fed, the US economy is doing great.
You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. The US economy basically fine. I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment.
After the rate was cut by 0.5% this week, the stock market was wildly celebrating yesterday. The S&P 500 went up 1.7% in one day, which means the stock market just set a new all-time high. But when you look at the underlying data, when you look at the results, I am a little bit confused as to what it is that we are celebrating. Just 3 months ago in June, 11 out of the 19 members of the FOMC said that interest rates would not need to drop by more than 25 basis points for the rest of this year. The majority of the Fed said that rates should be at 5.25% or higher. 4 of them said that rates do not need to come down at all. The other 8 said that rates would only need to drop 50 basis points in total this year. None of them said that rates need to come down anymore. That was just 3 months ago. Fast forward 3 months and suddenly all of them go and do a 50 basis point drop in one go. According to the paper, the vote was almost unanimous, with only one person voting for a 25 basis point drop. And today, those same people, experts, extremely clever experts, are saying that they expect the rate to fall another 50 basis points by the end of the year. And everyone is lapping this up. There are 2 meetings left, so that's 25 basis points per meeting. And the issue here is that this sudden, very rapid change in narrative, in what the Fed is doing, in what they are saying and what they are publishing, doesn't really go with this official statement that the economy is doing just fine.
The US economy is basically fine.
The two don't tally up. If everything is going great, why is there a sudden, very quick change from, maybe we'll need no rate drops at all, to doing a 50 basis point drop in one go? Why not take it steady? Why not just a 25 basis point drop? Or why not a 25 basis point drop at the last meeting and then another one this meeting if you really want to? If you read the data in the report, the Fed is basically congratulating itself, patting itself on the back, saying they have achieved their target. It is going to be a soft landing. It is going to be absolutely perfect. Everything is absolutely as good as it could be. But you really need to look at this data in a bit more detail to pick up on how insane and ridiculous this is. Maybe it's a nuance, I'm not so sure. Let's start with the unemployment data. You can see how over the last 3 years, since inflation went up and interest rates started going up, unemployment has steadily been creeping up. According to the Fed, unemployment will now magically stop going up exactly as it is. Just stop immediately right now. Unemployment right now is at 4.2%. Well, last month it was at 4.2% and it was at 4.3% the month before. And the Fed is now saying, look, it's been going up, but it's now going to just stop at this level and not go any further. It's not going to move anywhere. These are the projections from the Tweedledums at the Fed. And next year, unemployment will be exactly the same as it is right now. And in 2026, it will be roughly the same, but maybe come down ever so slightly. And in 2027, it will also be the same as in 2026. But going back to the unemployment graph, you know what the problem with this graph is? Well, aside from the fact that it's going up instead of being flat, the real problem is this. Let me zoom out to get the full data range. See, the last time unemployment went up, it went up in 2008. And it went up a lot very quickly because there was a massive financial crash, a lot of people losing their jobs. Then look in the dot-com crash. See how it also went up very quickly? An interesting history lesson here, if you look at unemployment going up, it has always, as in every single time, gone up very sharply. Look, every single time it's gone up very, very fast and a lot. Unemployment has never in history, in modern history, gone up a little and then just stopped. Never. And if you look at the start of every sharp increase in unemployment, there is usually first a steady period where there's a steady increase that precedes the big massive spike. Since this data starts 75 years ago, there has never once been a period where unemployment went up a bit and then just sat around, had a think and decided, you know what, nah, I'm not gonna keep going up, I'm just gonna stay where I am, or maybe go back down a little bit. And the increases have been sharp after these steady increases every single time. You get a sharp increase and then you get a steady reduction afterwards as the economy heals until the next time. And I'm not saying that the same exact thing is bound definitely to happen exactly right now because that's what's happened every single time in the past. No, what I am saying is that unemployment going up is not the problem. Unemployment going up is a symptom of a much bigger problem that is much harder to stop. That much bigger problem being what is actually happening, going on in the actual economy with actual companies. If you go on CNBC, if you watch finance YouTube videos, it's like everything is perfect. The economy is booming and everybody is talking about AI. News headlines on CNBC at the moment. Amazon introduces Amelia, an AI assistant for third-party sellers. Nvidia and a 1 trillion AI boom will boost tech stocks, says Dan Ives. UAE hoping to expand $1 trillion partnership with the US through AI investment. Maybe there's another headline that has a quadrillion in it. I haven't seen it yet. Everything about growth in the economy is AI. Every single egg in the whole thing is in that one basket. Meanwhile, back in the real world, McDonald's sales are down 1% year over year. Target revenues are down year on year. Apple revenue is lower now than it was 2 years ago. FedEx results just came out. FedEx are like the pulse of the day-to-day US economy. If businesses are businessing, then they are sending stuff to each other and to their customers. Well, FedEx stock is down 15% today after they reported a very bad quarter and revised their forecast down for the rest of this year and next year. Their CEO said that demand was weaker than was expected on the earnings call, particularly in the US domestic package market. People don't have money to spend because inflation in core essentials like rent, food, and energy means that people do not have money to spend on non-essentials. And we're seeing that in inflation data. We've been seeing it for months already. And companies are now beginning to struggle. The first thing that happens when companies struggle is they begin trying to manage their costs.
Never say fired.
Companies stop hiring new people. That's the easiest and fastest way to slow down costs. You stop hiring new people before you start firing your existing people, and that is the first sign. And look, since inflation went haywire, the number of new job openings in the United States has gone down by 40%, and it is continuing to march downwards. It's almost half what it was in early 2022. Now, here is something interesting. If you zoom out, the job openings at the moment are actually higher than at any point in the last 20 years before 2020. And that is a point that Jerome Powell made in his Q&A yesterday. The counter to that is that they're higher not because the economy is doing well, they're higher because the pandemic happened, which hasn't happened in the last 20 years. It has created a very unique situation. And it is a very primitive way of looking at the data, because if I take unemployment data and I overlay the job openings data, this is what it looks like. Unemployment is blue and job openings are red. Now, normally, as the number of job openings increases, unemployment falls, because for every person looking for a job, there are more jobs available. It's easier to find a job. But right now, the trend is moving in the opposite direction, which is highly unusual to be happening on a steady state. Job openings are falling and unemployment is beginning to tick up. And you can see that the rate at which this is happening looks very different to the rate at which the charts moved in the last 20 years before. So here is the beverage curve of this data. Please bear with me. You will find this super useful, I promise. So instead of looking at the data as you are shown it in all the usual reports, this chart shows you the rate of job openings on the y-axis, and you have the unemployment rate on the x-axis. And the different lines on here are just the different selected periods in time. So pay close attention. This yellow bit at the bottom, this is the financial crash. It's when employment went went down the toilet. And this yellow line starts here on the left and it walks down and to the right. That's what happens in every single situation when unemployment begins skyrocketing. The light blue line here is the dot-com crash. See how it starts in exactly the same spot and it walks down and to the right. Again, just like the financial crash. The red line is the bit between the dot-com crash and the financial crash. So first you have this blue line, it walks down and to the right. That's the first crash. Then the red line says, actually, I am going to go right back up. And eventually it walks back up to exactly where it started. And when it gets there, the red line gets you to the same point and the financial crash happens. That's the yellow line. Then you have the grey line. That's the 2010s. Economy was booming for a long period and this thing is walking right back up nice and slow, but it misses that point at which the previous two crashes happened, and it continues going higher. So for the same level of unemployment between 2016 and 2018, there were a lot more job openings, and that prevented the same situation happening again. So the economy was doing well because there were enough jobs to keep it sustained. And then at the end of the grey line, COVID happened, and everything went absolutely bananas. The data went off the chart to the right, to the top right, huge unemployment, but also at the same time relatively high job openings, historically speaking. A lot of people were moving from one type of job to another, and then from there to March 2022, the line walked up to the top up here. Very low unemployment and huge job openings. And that's when the market took a turn. A lot of people at the time were changing jobs, but the jobs were there. But then inflation hit and the rates went up. And you can see how the line, the black line, began going vertically down ever since. Unemployment has been creeping up very slowly, but not that noticeable on this chart. The line just moves to the right by a little bit, right? But it's pretty much just heading straight down towards this same point, where the number of jobs and the level of unemployment are at the spot, which typically indicates a big problem in the labor market. Because after companies stop hiring new people, if they continue being in a tight spot and need to go further, that's when the layoffs start. And if they start laying off people without new jobs being available for those people, that's when the problem happens. And we haven't seen any mass layoffs happen so far. The tech layoffs that people wrote about in the media by Google and the others are not really representative of what's actually happening in the broader economy. But all the data is pointing to the economy being way too tight and way too restricted, even with the rate falling 50 basis points. Remember, the next Fed meeting is in November. And even if they do another 25 basis point cut then, as they are saying, and then another 25 basis points just before Christmas, that still puts the interest rate at 4.5%, which is much, much, much higher than the rate of inflation right now, and could be much, much, much higher than the rate of inflation at the time. And this is a problem because it continues being highly restrictive. The biggest problem here is that a lot of companies were financing themselves a few years ago are now coming up for refinancing. 4.5% as an interest rate is not huge, historically speaking. And a lot of people in the comments write this, right? But the Fed created this problem by keeping interest rates at 0% for no particular reason for an entire decade after the financial crash. So this problem was artificially generated by the Fed in the first place. They created a situation where everyone's debt was sitting at 0%. And when debt has to be refinanced or replaced or whatever, and the interest goes from 0% to 4.5%, that is going to cause major problems. Corporate debt doesn't work the same way as your regular consumer loans. The rate is going down, but these drops should have happened a year to a year and a half ago. Now, the biggest problem is that the Fed is starting these cuts very, very late. Companies getting hit don't have the time to sit around and wait until 2026 when interest rates might come down towards something lower, and then wait another year or a year and a half for the impact of those lower rates to actually come through. These companies don't give a shit about the Fed's slow and steady approach. We already have deflation in the consumer price index when you're looking at month-on-month movements of everything except for shelter. Consumer debt is at an all-time high, and the personal savings rate is at the lowest level since the financial crash in 2007. People don't have the money. Unemployment data is apparently doing great, according to Jerome Powell, but here is new data for earnings in the US. Real earnings are growing above inflation. You can see that these real numbers are positive, but the number of hours worked is dipping year on year. And you can see that the number of people working in part-time jobs is currently at the highest level ever. If you look at the Fed's projections, they are basically saying that their best guess right now is that everything is going to turn out perfectly. Of course. And you know when someone comes out and things seem a little bit difficult, things seem a little bit uncertain, you don't seem to feel like, everything is going that great. But then that person comes out and they say, everything is fine, absolutely fine, no, nothing to worry about, with a super condescending voice. Well, that's exactly how the Fed sounds right now. Look, according to the Fed, GDP is going to grow at exactly 2% in 2024, and in 2025, and in 2026, and in 2027. Well, it can't really get much more perfect than that, right? Look, the range of their answers is 1.8 to 2.6 in 2024, and in 2025, the range is 1.3 to 2.5. It's amazing that every single one of these super smart economists seems to have a completely identical view on this. And PCE inflation, well, they had to reduce their forecast because inflation is already lower than what they forecast back in June. But look at it. They are saying that they expect it to be absolutely fucking perfect, like the best landing ever. It's going to slow down gradually over the next 3 years to end up bang on exactly on 2%. Don't worry, it won't get to 2% until 2 and a bit years from now because they have timed it absolutely perfectly. And look at the range. 2.1 to 2.7% for 2024, 2.1 to 2.4% for next year, and 2.0 to 2.2% in 2026. Wow! Amazing how all of these people guess the same exact number independently, which just happens to also be their target. What the actual fuck is the point of having 19 of these idiots in a room, literally every single one of them just parroting the same exact bullshit? What is the point of this committee if they just repeat whatever the boss tells them to say? Where is the critical thought? Where is the challenge to the bullshit? And you know how I know that these people are full of shit and complete idiots? Well, here is the same people projecting in December 2021. Inflation in December 2021 was already at 7%. PCE inflation was at 6.2%. But the interest rate was still at 0% because the Fed would wait another 4 months before making the first increase. So when inflation in December 2021, at the end of 2021, was at 7% and climbing, the Fed guessed that in 2022, the next year, inflation would be between 2 and 3.2% at the end of the year. It's right here. This is their actual vote from that meeting, their actual prediction. I find it bizarre and astonishing that so many people choose to forget how completely incompetent and incredibly stupid these people have been in the past. It's black and white. There is no ifs and buts. I mean, to me, this is clear dereliction of duty. This is playing politics at the expense of regular people who get fucked when the economy goes downhill. There is no way anyone with more than 2 functioning brain cells would look at inflation sitting at 7%, interest rates sitting at 0%, inflation still marching upwards, and genuinely believe that inflation would just magically, all by itself, be down at 2% the very next year. So when I look at the forecast now, I think the same exact thing about these forecasts as I did back then. I think the same exact thing about the ability of the Fed to do their job. They are incompetent and have no idea what it is that they are doing. Based on the data that we have today, unless the US economy pulls out another rabbit out of a hat, which, could happen. The US economy has shown crazy resiliency over the last few years, But based on the data that we have today, it is hard to believe that inflation will not be dropping below 2% in the coming months. Anything can happen, but the numbers are pointing to inflation being below 2% and continuing down towards zero at the end of this year, going into next year, because it is already there. We just haven't got the shelter numbers come down low enough yet. But not a single member of the FOMC apparently thinks that this is probable. Not one. Unfortunately, a rate cut doesn't magically have an immediate impact. That's not how it works. Just like the rate increases took time to filter through and have their effect. So as the Fed is just starting to reduce rates now, that isn't going to help much right now. And behind the scenes, away from the media circus, I think some people are getting concerned. Look, 10-year treasuries have gone up since the rates dropped. Not down, but up since the rate cut. You'd think that they would be dropping, right, as rates are going back down. Therefore, the expectations on what the long-term rate is should be falling. But it sounds like maybe there is a niggling worry there as to why the Fed is cutting rates, right? What is the reason? Are they cutting from a position of strength where they have solved all the problems? They can go and boost the economy even more because they've done their job? Or are they cutting because they fucked up once again and will now be cutting rates way too late, way too slowly as the economy gets hit? Well, I guess we'll have to wait and see.